Hey everyone, welcome to another Level Logic video where my goal is to make the best data visualization indicators available on TradingView. Today I'll be going over HIPA, which stands for High IRL Probability Areas. Currently this indicator focuses only on NQ futures, however I will be looking to expand its capability to other futures assets like ESCL, GC and BTC in the future. If you would like access to this indicator or any of our other data-driven indicators, head on over to levellogicindicators.com for more information. Links are in the description of this video, but let's get into HIPA and how it works. So again, like with my C's video, let's quickly revisit how a candlestick is built because this is the basis for how I view price action and what level logic indicators are based on. So a candle is really just a summary of movement over time. Here we have one high time frame candle and the red line represents the low time frame price action within that candle that's being summarized. The high time frame opens and then it needs to find its lowest point, then it needs to find its highest point, and then it closes. So we call this OLHC, which is open, low, high, close. Okay, here we have the opposite pattern, open, high, low, close, or OHLC, where the high time frame candle opens and finds its highest point, its lowest point, and then closes below its open, which is typical for a bearish formation. And why OHLC matters is because we're trying to capture the maximum efficiency trade. So for a bullish candle, it doesn't really matter what time frame, let's say it's the daily. If it's a bullish day, you want to be getting in as close to the low wick as possible to ride the expansion higher. And a bearish day, you want to be getting as close to the high wick as possible to ride the expansion lower. What we're going to look at in a minute is how HIPA visualizes for you both external and internal range liquidity. So let's first look at how external liquidity can be easily summarized by high time frame candles. You can see these three candles on the left. We have a high, higher high, and lower high. This forms a pivot or fractal high. Looking at an example of low time frame price action, the path of that red line, we can see price was trending up. We break one last time to the upside, which is usually a little sweep, and then we can begin breaking down and taking out candle high time frame candle lows. This sort of structure typically makes stronger external liquidity as they are pivots or reversals in the market where a lot of stop orders will be resting above or below. So here's just a quick example of the opposite case for a low, but it's basically the same thing. So you've got a low, lower low, and a higher low forms your pivot low. And then we see the example of the low time frame structure there that's being summarized by these three high time frame candles on the left. So the lowest low there is your external range liquidity. So next up, we've got internal range liquidity, and this is what HIPA focuses on with showing you probabilities. So in this example, we're breaking highs whilst not breaking lows, meaning the lows have resting stop orders for traders in longs, and they are, for the moment, protected lows as the market moves higher. On the low time frame example, you can see we are trending up with pullbacks, breaks of structure, and internal sweeps of smaller time frame lows. But all of this price action is again summarized into the most significant points by the high time frame candles on the left. Price will often build up or engineer this liquidity through the session, day, week, month, etc. before moving aggressively through it. HIPA is focused on the intraday, looking at 30-minute untested highs and lows. It is built on analyzing over 15 years of aggregated OHLC data points. Because some liquidity needs to build, you will not see any liquidity being drawn by HIPA until after midnight open. So here at this point in the graph, we are at midnight and we can see all the 30-minute intervals back to the daily open. At this point, we now have almost the entire trading day to take out these levels. So you've got about 17 and a half hours. So probabilities are still quite high to take out these levels. As we go through the day, however, our probabilities have a time decay. This is because if the 30-minute highs or lows have not been tested yet, price now has fewer hours left in the day to actually test them. Here we're looking at 9 AM to the end of the day. So you can see those times we looked at before, which were high probability, above 80, 90%, have now dropped quite a lot. So they're down more around the 50% mark. However, intervals closer to current price have a high probability to get taken out by the end of the day. Okay, so let's now get into HIPA, how to set it up, and what it's actually going to show you. So HIPA is an all-in-one liquidity indicator. It uses a unique logic which builds the higher time frames on the lower time frame chart, making it truly multi-time frame. In the external liquidity section, you can see you can choose from up to 3 high time frames, which is going to show you your external range liquidity. And you have the option to use stronger pivots, as we spoke about before, for that time frame, or the time frames candle high and low instead if you unclick the show only pivots one. Looking at the chart here, to avoid confusion, I've just set the 12-hour pivots to on. So you would expect these to be strong liquidity areas. This is a 5-minute chart zoomed right out. You can see that a lot of the time, soon after taking the 12-hour external liquidity, there is a significant shift in price. So these are the best places to take reversal style trades from. But it's important to remember that you don't want to just take any reversal trade after taking some random external liquidity. You also want internal range liquidity to power your trade in the right direction. So the bulk of HIPA's capability is made up of IRL and the probabilities for it. This is basically giving you live, dynamically updating probabilities of what I just showed you in those histogram graphs. When lines are crossed, they will go from solid to dotted to indicate they've been tested. And in the inputs, you can choose to show or not show these tested lines. Here I'm just showing you untested lines, and you can see we have a lot of IRL resting above where price is at now. Each line will give you 2 probabilities. CH is the current hour you're in and is a dynamically updating probability based on how much time you have left in the day to achieve taking out the liquidity, based on the historic data. So similar to what we discussed earlier in those histograms, how you've got sort of less and less probability in time decay as you move through the day. EOD is end of day, which is not dynamic. So this is a fixed probability of how often this level has been taken out by the end of the day in the past. If we now add in our external range liquidity, which is these lines going across here, we can see we took out previous IRL, which was all of this inside stuff, to take out the external at the bottom there. Now we look for confluences and use your desired entry model to target the IRL, which we've now formed above, with high probabilities attached to it. You can also, in the settings, activate a signal area, so you can turn that on and off to highlight when A, you have a disproportionate amount of IRL with high probability in one direction, and you've also recently taken out external range liquidity of the high time frame settings that you've set. These are not signal areas in that you should just immediately slap on a trade. They are just signaling that price is getting one-sided and often reverts. So here you can see more clearly when we add everything together, how in both cases we take IRL over here, and then move through, get the signal area. We have some multiple high probability internal range liquidity lines that price then moves through, all the way down to taking out some other external range liquidity. And whilst we're doing that, we're building up these highs to the upside as more internal range liquidity, and then we get the signal area and we go back up to take that. So this is a nice example. It doesn't always happen like this where you take the entirety of the internal range liquidity. If you go back and you remember those histograms, the highs and lows that are closer to you in price are more likely to get taken out. So the idea is that you look for clusters of these and you can use them as an early target if you want to scalp, or you can use them as a target to get you to break even and then, or even take some profit there, to then hold and target the rest. And that's Hyper. Again, if you want to explore it further, check out the website, levellogicindicators.com, or you can follow me on X at LevelLogicTrade. I post daily examples up there so you can see how I'm using it. Yeah, I hope Hyper gives you a clearer view of the market and helps sharpen your edge. It's great to use with LevelLogic's other indicators so you can stack some confidence. And I'll see you in the next one.